Welcome to the deep dive. Today, we're really getting into it, going deep into a source you suggested, Morgan Housel's The Psychology of Money. We want to figure out what's really going on when we make financial choices.
Yeah, it's quite something. We get hit with so much financial advice, don't we? Tips, formulas, data. It's endless.
Totally.
But this deep dive, well, we're aiming for something deeper, trying to uncover those, hidden human behaviors, the feelings that kind of steer the ship, financially speaking, why we succeed or why we stumble.
Right. It's like the operating system running underneath all the spreadsheets and market charts.
Exactly. And House makes this, I think, really compelling case that, yeah, the technical skills matter, but maybe not as much as our psychology, how we think about money, how we feel about it.
That's the core idea, isn't it? The soft skills, the relationship with your own mind, that might just be the biggest factor in whether you do well financially.
And it's so personal. That's what's really striking. Our own lives, the economy we grew up in, whether things felt stable or shaky, all that stuff molds how we see risk, reward, what we even want money for.
Yeah, think about it. Someone who grew up with very little, their gut reaction to risk is probably going to be worlds apart from someone, say, whose parents were wealthy bankers.
Oh, absolutely. It's almost baked in, isn't it?
Yeah.
Or someone who lived through hyperinflation versus someone who only ever saw prices stay pretty stable. Very different outlooks.
Housel gives great examples, like a stockbroker who lived through the Great Depression. That wasn't just theory for them, that was real.
Visceral, yeah. Compared to maybe a tech worker in the late 90s boom, it felt like things could only go up, right? Different worlds, different lessons imprinted on us.
And it's not just the huge crises, even like the background economic weather shapes us. He mentions an Australian who maybe hasn't seen a recession for 30 years.
Hmm.
Their assumptions are just different from an American who's seen a few cycles. It's like they're operating with different default settings.
Which leads to this big challenge, right? How do we learn from all of financial history when our own little slice of it is so unique?
Yeah.
The JFK story Housel mentions is perfect for this. Kennedy admitting he didn't really get the Depression because his family was wealthy.
Right. He had no firsthand knowledge of that struggle.
Exactly. It shows that gap. You can know something intellectually, but without that personal experience, it's different.
Yeah.
Harder to truly learn the lesson, maybe.
Okay, so let's dig into this tension Housel talks about a lot. Skill versus luck. How much of our financial outcome is us and how much is just chance? Risk.
Ah, yeah, this is fascinating because we tend to, see our successes as our own doing. I worked hard. I was smart.
Of course.
But failures, oh, that was bad luck. External forces. But when we look at other people,
But flip it, right. Their success was luck, right place, right time, but their failures, they messed up.
it's a total double standard.
No.
Housel tells this story about a tech exec, super brilliant guy, designed key Wi-Fi parts, sold companies, but he was also working as a hotel valet on the side. His personal finances, a disaster. Overspending, insecurity.
So genius in one area doesn't mean genius in managing money.
Not at all. It makes you think about that Robert Schiller quote asking about the exact role of luck. It's humbling, really, because it's always a mix, isn't it? And trying to pick apart skill from luck is, well, almost impossible sometimes.
So what does that mean for who we learn from? Housel warns against focusing too much on the extremes, right? The billionaires or the massive flameouts.
Yeah, because those stories often have huge doses of luck or, extreme risk involved. Their specific path might not be that useful for the rest of us trying to navigate our own finances.
It makes sense. Think about those old tycoons like Vanderbilt or Rockefeller. Were they bold or just reckless?
Exactly. And the answer often depends on whether they succeeded or failed, doesn't it? Luck plays a huge role in how history labels them. The line's really thin.
History written by the winners who frame their gambles as genius in hindsight.
Pretty much. Which connects to this idea Housel calls tails drive everything.
Explain that.
It means that a small number of events, like really big wins or really big losses, the tails of the probability distribution have a massive, outsized impact. Way more than all the little ups and downs in the middle. Black swan events, basically.
Okay, so these rare big events are what really shape things.
Yeah. And that brings up this question about, well, what are we even aiming for? That John Bogle story about the billionaires party.
Oh yeah, with Kurt Vonnegut.
Right. And Vonnegut points out the billionaire host has everything, but probably still doesn't feel like he has enough.
Because the goalposts keep moving.
That's it. Housel says maybe the hardest financial skill isn't picking stocks, it's just getting those goalposts to stop shifting. We see what others have, we compare.
Social comparison. It fuels that feeling of never having enough.
And that chase for more can make us take stupid risks, which is why household stress is there.
Hmm.
Some things are just never worth risking, no matter the potential upside.
Like the Rajat Gupta example. Insider trading. He
Yeah.
had so much already.
Immense wealth, reputation, threw it all away for a bit more. And the regret, Housel notes, was immense. Some risks just aren't worth the potential reward because the downside is total ruin.
Okay, so that's a crucial point about risk and goals. Let's shift gears slightly to something that seems simpler, but Housel argues is incredibly powerful. Compounding.
Compounding. Yeah, it's almost like financial magic, but it's slow magic.
Slow magic, I like that.
It's counterintuitive.
Right.
We often chase the big wins, the highest returns this year, but Housel shows that just getting like pretty good returns consistently over a really long time, that's far more powerful.
It's the reinvesting, the gains, earning gains.
Yeah, that exponential growth. And the key ingredient is time. Loads of time.
Warren Buffett being the classic case study here.
Absolutely. Housel breaks it down. Most of Buffett's wealth isn't from like insanely high average returns year after year. It's good returns, sure, but sustained over an incredibly long time, starting super young.
That duration is the real kicker.
Totally. And the thought experiment is amazing. If Buffett started later, say in his 30s, and retired in his 60s like a normal person,
His wealth would be tiny in comparison, right?
like 99.9% smaller, it's staggering. His genius is real, but time is his superpower. Starting early and just sticking with it for decades, that beats trying to nail market timing.
And he contrasts Buffett with Jim Simons.
Right, from Renaissance Technologies. Simons actually had higher average annual returns, phenomenal numbers, but he started later. Hasn't compounded for as many decades. So his total wealth, while huge, isn't quite at Buffett's level. It just hammers home the power of time in the equation.
We just don't intuitively grasp exponential growth, do we? Housel uses the hard drive example.
Yeah. Storage capacity grew kind of slowly at first, then boom, terabytes, it sneaks up on you. Slow and steady really can win the race if the race is long enough.
But trying to rush it can be dangerous. Like Jesse Livermore.
Oh yeah, the legendary trader. Made a fortune in the 29 crash.
And then lost it all later. Overconfidence.
Exactly. Big wins don't guarantee anything if you don't have humility, if you lose that healthy fear of loss. Contrast him with Abraham Jermansky, who was just wiped out by the crash. Different outcomes, same event.
And that idea of longevity comes up again. Michael Moritz at Sequoia.
Yeah, emphasizing survival as key to their long-term venture capital success. You have to stay in the game.
Buffett's story about his friend Rick, too. Smart guy, but impatient.
Got caught by margin calls in a downturn. Wiped out. Patience is critical. Survival is the prerequisite for compounding to even happen.
Okay, so survival is paramount. Time is your friend, but only if you stick around. How do we ensure we survive?
Well, that leads directly to Housel's focus on essentially building resilience. It's not just about maximizing gains. It's about being able to take the hits. The market will be volatile.
You can't avoid the downturns entirely.
Nope. So you need that margin of safety. It's about building in a buffer, some wiggle room, so that when unexpected stuff happens and you don't get knocked out.
He calls it a barbelled personality, right? Optimistic long-term, but paranoid short-term.
Exactly. It's a great way to put it. You believe things will generally work out over decades, but you're also acutely aware of all the things that could go wrong tomorrow and stop you from getting there. Plan for the best, prepare for the worst.
That connects back to the tails drive everything idea too, doesn't it?
Yeah, because in investing, a few big winners often account for most of the portfolio's gains. Failure is normal for individual investments.
Even famous companies had near misses. Disney's early days.
Almost went bankrupt multiple times.
Yeah.
Or think about big movie studios like Carolco, huge hits, then collapse. Success isn't permanent. You need resilience in your overall approach, not just relying on one winner.
It's about the whole portfolio, not sweating every single stock pick.
Right. And that story also tells about Sue, the hypothetical consistent investor from 1900 to 2019.
Just investing steadily through everything. Wars, crashes, booms.
Yeah. Her genius wasn't amazing timing. It was just doing the average thing consistently, especially when everyone else was freaking out. That consistency is a form of genius in investing.
And having cash helps with that consistency, right? Even if it doesn't earn much.
Hugely important. Cash gives you options. It stops you from being a forced seller at the worst possible time, like in a market panic. It's a shock absorber. It prevents mistakes you can't recover from.
So planning is good, but flexibility is maybe even better.
I think that's fair to say. Plans are essential, but life throws curveballs. Being able to adapt your plan, having a somewhat loose timeline, that's crucial for actually reaching your long-term goals.
Okay, let's dive into the core. Our own psychology. This is the heart of the book, right?
Absolutely. And it also makes this fundamental point.
Mhm.
What most of us really want from wealth isn't just stuff,
Hmm.
it's control.
Control over our time.
Exactly.
Right.
Freedom, autonomy, the ability to do what you want, when you want, with who you want, for as long as you want. He says that's the highest dividend money pays.
And he uses his own experience in investment banking as an example. High pay, but
Zero control over his time. It made him miserable, even with the money. It's a powerful trade-off.
which might explain that paradox. Wealth has gone up in the US, but happiness hasn't necessarily followed suit.
Yeah, it's striking. Maybe we've traded some of that time control for more income, more stuff,
Yeah.
modern jobs, always being connected. The lines blur. We lose that autonomy.
So more money doesn't automatically equal more happiness if you sacrifice your freedom for it.
It seems that way,
Mm.
which leads to his distinction between rich and wealthy.
Okay, what's the difference there?
Rich is often about high current income, visible spending, the fancy car, the big house. Wealthy is the money you don't see. It's the unspent assets, the savings, the investments providing security and options.
Like Rihanna nearly going bankrupt despite earning millions, rich, but not wealthy at that point.
Perfect example. Wealth is what you don't spend. The only way to build it is to spend less than you earn. That gap, that saving, is way more controllable than trying to hit home runs in the market.
And he argues a lot of spending beyond the basics is ego-driven.
Yeah, trying to signal status, keep up with the Joneses. He suggests humility, focusing less on what others think, is actually a powerful savings tool. Unseen wealth buys freedom. Visible wealth often just buys stuff that doesn't bring lasting happiness.
That flexibility, that control over time, that's the real, though invisible, return.
It's invaluable, which ties into why trying to be perfectly rational with money often fails.
Because we're human, not robots.
Pretty much. Housel argues aiming to be pretty reasonable is much more effective long-term than striving for cold, hard rationality. The math might say one thing, but if you can't stick with a strategy emotionally, it's useless.
He uses that fever treatment story.
Yeah, Wagner-Jarrick. Logically, maybe suppressing fever seems good, but biologically, it's part of the healing process. Sometimes what seems less optimal is actually more practical and effective in the real world. Finance is similar.
Like Harry Markowitz, the Nobel Prize winner for portfolio theory.
Admitting his own portfolio wasn't the mathematically perfect one from his models. He chose one that let him sleep well at night. Psychological comfort matters.
There's research showing theoretically optimal strategies like using lots of leverage for saving are just not realistic for most people emotionally.
Exactly.
Yeah.
Sometimes just loving your investments, feeling good about them, helps you stick with them, even if it's not perfectly optimized on paper. Being reasonable beats being technically perfect but unable to follow through.
And forecasting. We all do it, but we shouldn't rely on it too much.
Right. It's natural to try and predict things, but Housel cautions heavily against thinking past experience makes you a good forecaster. It can just lead to overconfidence.
Michael Batnick's point about interest rates, just
Mhm.
because you've seen rates rise before doesn't mean you know exactly how the next time will play out.
Precisely. The world keeps changing. The real lesson from surprises isn't that we should have predicted them, it's that the future is fundamentally hard to predict.
And even history isn't a perfect guide because the structure of the economy changes, like 401ks, venture capital.
Yeah, the whole landscape shifts. The rules of the game evolve. So
Right.
past patterns don't always repeat exactly.
Okay, shifting again. Housel finds wisdom in blackjack. Card counters.
Yeah, it seems odd, but it's about their approach to risk and uncertainty. Even when they have a slight edge, card counters know they need a big margin for error.
Because they can still lose hands. Randomness is always there.
Exactly. They bet based on that uncertainty. They're humble about prediction. They know they can't bet everything, even when the odds look good. Never bet every chip.
Which sounds just like Benjamin Graham's margin of safety in investing.
It's the same core idea. Deliberately building in a cushion because you know things can go wrong unexpectedly. The bigger the cushion, the less perfect your forecast needs to be.
Like Bill Gates keeping a year's payroll in cash for Microsoft early on.
Survival first. He wasn't just focused on growth. He was obsessed with not dying, ensuring the company could weather any storm.
And we need an emotional margin of safety too, right? To handle the market swings without panicking.
Absolutely critical. If you can't psychologically handle a 30% drop without selling everything, your financial plan won't survive reality no matter how good it looks on paper.
Leverage makes this way harder, obviously.
Oh yeah. Leverage turns normal volatility into potential ruin that German tanks and mice story Housel uses.
How tiny, unpredictable things can cause massive failures.
It just shows you can't predict every risk. You need buffers, you need to avoid single points of failure because crazy, unexpected things happen. The most important part of a plan is planning for the plan not to go according to plan.
Okay, so avoid fragility. What about avoiding extremes in our thinking and embracing change?
Housel tells that story about his friend who worked so hard to become a doctor.
Only to realize he hated it.
Yeah. It shows how hard it is to predict what will make us happy years down the line. Our goals change.
Which links to that end of history illusion. We tend to think our current self is the final version.
Right. We think our current values and desires are fixed, but they're not. So making super rigid 30-year financial plans based on who you are today can be a mistake. You'll likely be a different person with different goals in 10 or 20 years.
So aim for moderation. Don't go to extremes in saving or spending.
That's his advice. Moderation in savings, free time, work. It increases the odds you'll stick with a plan long enough for it to work, and you'll have fewer regrets if your priorities shift.
And be willing to change your mind. Don't cling to old goals just because you set them once.
Exactly. No sunk cost when it comes to your life goals. If a past financial plan doesn't fit who you are now, ditch it. Adapt.
All right, let's talk about the price of investing. It's not just fees, is it?
Not at all. Housel uses the fall of GE, this giant that seemed untouchable, to show that success isn't permanent and there are always hidden struggles. Investing has a price, but it's often paid in things like volatility, fear, doubt, uncertainty, regret.
And trying to get the returns without paying that price, it doesn't work.
It's like trying to steal a car instead of buying it, he says. You might get away with it for a bit, but it usually ends badly. Trying to time the market perfectly to avoid all downturns.
That's why the average investor underperforms, right? They jump in and out.
Yeah, they're unwilling to pay the fee of volatility. Housel points to GE focusing on smooth, short-term earnings or Fannie and Freddie's accounting games. Trying to create an illusion of predictability is dangerous.
So we should view volatility as the cost of admission, like paying for a theme park ticket.
Exactly. It's the fee you pay for the chance at higher long-term returns.
Yeah.
If you see it as a fine or a punishment, you'll make bad decisions trying to avoid it.
And a big mistake is taking cues from people playing a different game.
Huge mistake. A day trader's goals and time frame are completely different from someone saving for retirement in 30 years. Why would they value an asset the same way?
The dot-com bubble being a prime example of clashing games.
Totally. Short-term momentum traders versus long-term value investors. You have to know your game, your time frame, your goals, and not get swayed by what others are doing if they're playing differently.
Okay, final topic. The lure of pessimism. Why does bad news seem so much more compelling?
It's a really interesting point Housel makes. Pessimism just grabs our attention more, doesn't it? It often sounds smarter, more insightful. That 2008 article predicting the end of the U.S.
Yeah, people remember stuff like that.
There are psychological reasons. Bad news feels more urgent, like we need to react. It often affects everyone. And maybe stories about decline are just easier to believe somehow.
Even though history shows long-term progress.
Yeah, Ridley and Rosling point that out. There's this constant drumbeat of doom, even when things are generally getting better slowly. Pessimists often just extrapolate current bad trends forever.
Without factoring in adaptation and innovation, like the peak oil scares.
Exactly. Then fracking comes along. Markets adapt. People find solutions. Progress happens slowly. Setbacks happen quickly. So the setbacks get all the attention.
That alien visiting in 2007 and 2009, not much physical change, but a massive shift in mood and wealth because the narrative changed.
Powerful illustration. Sentiment drives so much.
And finally, this ties into how much we want certain things to be true, right?
Yeah. The more you want something like a guaranteed winning investment, the easier it is to believe a story that supports it, even if it's unlikely. Like the hope after World War I that it was the war to end all wars. High stakes make us susceptible.
And we fill in the gaps in our knowledge with stories to make sense of things.
We crave complete narratives. Even if we only have a tiny piece of the picture, we build a story around it, like a kid trying to understand the world. This leads to overconfidence, thinking we understand the market better than we do.
Kahneman's point about focusing on our plan, ignoring everyone else's plans and luck.
Right. We neglect the competitive landscape and the role of chance. And that story of Clarence and the dentist in 1931, This idea that there used to be one right way.
Compared to now, where we accept individual preferences, patient consent.
Exactly. And finance is the same. There's no single right answer for everyone. It depends on the individual.
Okay, so wrapping up this deep dive into the psychology of money, key themes seem to be understanding ourselves, our own biases.
Definitely. And how our unique experiences shape everything. The power of time,
Mhm.
compounding, but only if you survive.
Right, survival. Margin of safety is crucial. Avoiding extremes.
Understanding the real price of investing volatility, fear, and being aware of how pessimism grabs us.
And ultimately, Housel's point, no one is crazy. Our financial views make sense based on our own life story.
Yeah. It's about self-awareness, aligning your money decisions with your goals, your comfort level,
Yeah.
what lets you sleep at night, not some theoretical optimum.
So, a final thought for you listening. Housel touches on the changing American consumer later in the book. Thinking about that, how do these deep psychological drivers we've talked about play out today in our constantly shifting world? How does your psychology interact with today's economy? Something to chew on.
Definitely food for thought. It's
Wow.
all about reflecting on your own stories about money.
Thanks for joining us for this deep dive.